Wise is next, and Wise was not the most detailed report of this week, and so it's kind of interesting to focus on. But the stock finished the week, or I say finished the week. I was looking in the sort of middle of the day today. It's Friday now, down 5%, but on Thursday went down 10% after they released their Q1 trading update, and it's basically a sales update. Although Wise doesn't necessarily call their sales, they call them underlying income, and that kind of makes sense when you get into the details of what it is a bit. But that word income shouldn't lead you to confuse yourself, and as it did me very briefly a few reports back, when I thought, hang on, if that's their income and that's their market cap, they're trading at like 5 times earnings. This thing is an absolute steal. It's not that, but there isn't a kind of below the top line approach here for the moment. But I looked at this report, and my sense was that this report had both good and bad things about it, and I thought that the good effectively outweighed the bad, so I thought on balance positive, but not universally blowing the doors off positive. The market didn't agree, but the market did have this stock at a slightly higher multiple than I was ready to buy it at beforehand. So I can understand the market sending it the other way, even though I'm not so sure about it on the basis of these earnings. If I was the kind of person who owned Wise beforehand, I'd be much happier buying it now. I'm not that person, and I might be happy buying it now. Add this to the endless list of stocks that I'm apparently buying right at the moment. But anyway, what went on with this thing? Wise, for those of you who don't know, and you should try to listen to our show a bit more in that case, because we talk about it quite a lot, is a payment processor focusing on cross-border transactions, and their aim is to become the best cross-border transaction platform by being faster and cheaper and more reliable than everybody else. Okay, how are we doing in Q1? Well, they grew their user base by 17%, which resulted in them sending 24% higher total payment volume, which involved this thing called underlying income. More on what that is in just a second, being up by 11%. So underlying income involves partly their kind of take rate, or not their take rate, the amount they take in charges for facilitating these transfers, plus 1% interest of the interest they collect on customer deposits. Now, they collect more than 1% interest on customer deposits, but they consider the rest of that to be kind of vulnerable to interest rate fluctuations here. And if interest rates go down, they think that might go away, but they reckon they can probably hang in there at 1%, basically. Okay, fair enough. I think that's conservative. I've said that before here, but sure. That's the way we measure these things. So that metric of basically transaction fees-ish, plus 1% interest here was 11% higher than it was before. So what's not to like about this? Well, there are potentially, I think, 3 things, one of which is a very bad thing to not like, one of which I think is a reasonable thing to not like, and another is a question mark thing to not like. Here's a very bad thing to not like. Their take rate came down from 0.64% to 0.52%. And why would you not like this? Well, in general, it's not a great sign to see companies just slashing prices to boost revenues. We see this in Tesla's been a good example that we've been quite critical of forever discounting stuff, offering lower prices to try and drive sales at the cost of margins and profits. And that's true of a lot of businesses. But Wise's ambition here is, I don't think this is a sign that they're doing it because they're uncompetitive. They put it down to 2 reasons. One was they offer lower take rates on higher volume transactions, and part of that was the average coming down as a result of some higher volume stuff. And the other is they did say that their general rate had come down slightly on top of this, but that's just them getting cheaper than their opponents in these situations. They're deciding it's effectively, if you want to think of it this way, reinvesting back into your business to make things more efficient in the future, albeit you don't kind of get the cash and then hand it into something to reinvest. You effectively just don't take it in the first place and give it away before you've kind of collected it, or instead of collecting it. So that neither you nor I strongly suspect, Steve, is a good reason to dislike this trading report. In fact, it might be a positive. The more that comes down, the harder they become to compete with. Because Wise at scale operating at a take rate of 0.52%, someone's got to try and get underneath that and then make a profit like that, and that's going to be very, very difficult. Wise can do it. We will see how their profits look. They didn't talk about them in this report. It was basically a sales report. We'll see when Q2 and the H1 report comes out. But we'll see what their profits look like. I expect them to be up slightly, but not as much as their revenues. Another reason to dislike this, and maybe a more reasonable reason, I think, to dislike this, is that it is short of what they're guiding for over the kind of medium term. They're guiding for growth between 15 and 20%, and officially their growth came in at 11%. Now, you can adjust that for FX and call it 14% if you like. And I think you should adjust that for FX, because when companies like Wise offer you guidance at 15 to 20, that is not, I think, or it would be strange to think it was, building in forecasts about what FX rates are going to do. So I think whether they help you or hinder you, and in this case they hinder them, you should knock those back out again. So if they came in at 22 and FX took them back down to 16, I think you should call it 16. In this case, it's the other way around. They're in at 11. FX puts them at, they're officially 11. Knocking off FX takes them up to 14. I think you should call it 14. It's a little bit short of the guidance. I think that's a reason to not like this. I don't think it's a massive reason to not like this. More on that in a second. The other thing worth noting is where their kind of revenue growth came from. So their transaction charges were up, and was their interest on deposits. The kind of core of this is shifting money cross borders. The kind of Wise mechanism for do this means it doesn't actually move across any borders, but you get the sort of general thought. That's kind of the clever bit, actually. But the faster growth was on the interest and deposits side, which isn't really the kind of core part of things, but maybe you prefer growth from the other part of the business. Sometimes we prefer growth from one area to growth to another, and maybe that's right. So we're slightly light on momentum here, but I suppose back to the main kind of objection I have, which is it's under their guidance here. Was anyone's investment thesis really about Q1 2025 numbers? I mean, maybe. No doubt there are some kind of traders out there who thought this was going to have a good Q1 2025 and they're now going to be disappointed in cross. But I think for the BritBox, you who owns this stock, Steve, me who's considering owning this stock, it's about where it's going to be kind of eventually. Their aim is to process an unspecified number of trillions in transaction volume. And their current market for this, I think, is around 195 trillion, 40 trillion of which is sort of retail transactions. If you assume that market never grows, which it will, but assume it doesn't for the moment, assume they managed to make their way up to a 5% market share for 2 trillion, keep a 0.5% take rate slightly below where they currently are, gets you to 10 billion. This is all dollars, by the way, in revenues. Their current market cap is 10.6 billion in pounds. So you're looking at a price to sales of about 1.2. They get to anywhere near this number. It's not expensive at today's prices, Steve. And that, I think, is probably where you look at this company. What do you think?
Yeah, so there's a couple of things really. So the take rate reduction is so there's a saying in business, when you see companies with really high margins, basically the competitors are supposed to look at that and say, well, your margin is my opportunity, kind of thing. And that basically means to come under you and obviously try and take the business from you. Wise doesn't allow people to have that issue because it is constantly trying to reduce its prices and bring them down. And that margin there will make competitors sort of think, well, why bother? Because we're not going to get it any cheaper than Wise. But also in the unusual circumstance, Wise is actually faster as well. So the product is better, cheaper, and faster. So it's unlikely that any startup is going to look at this kind of industry and go, wow. If we can go lower than 0.52%, we do you know what I mean? We could because you need massive economies of scale even at that rate to make any kind of money out of it. And all the time you're developing the product, why is it just going to try and get cheaper and cheaper and cheaper and cheaper? Because that's the dream for them is essentially for FX to be almost free, and the sort of volume and customer holdings to be what keeps Wise going. But yes, we've had a bit of first-hand experience with Wise, Steve, and I was speaking to my dad. He's an old man now, and he said that he wanted to send some money to my uncle who lives in Canada, who has I think it was his birthday or something like that. So my dad wanted to send him an amount of money, not a huge amount of money. It was a few £100 for his birthday. Go and enjoy yourself, kind of thing. He's a Barclays customer. He went to send it through Barclays FX exchange. He got charged about 6% on the transfer, Steve. how long did it take the transfer to arrive, would you say? And this is, remember, this is from Britain to Canada, so these are not like they've got the same queen, same king.
I was going to say they
So
haven't
Steve,
got any at the moment, but
how
I
how long?
I have this idea in my head. It takes about 3 days, but I have this idea also. Another idea. It might be massively longer. Go on.
Yeah, add 20 days to that. It was nearly 23 days before it
Funny
appeared.
enough, I thought it was either 3 days or 3 weeks, and I thought 3 weeks was too long.
Yeah, so that kind of shows you what this is Barclays sending to one of the large. I think it might have even been Bank of Canada. So these are not small banks. Neither of them, both of them have huge FX transactions, and that's how long and inefficient and expensive it was. So I showed him whys anyway, and yes, I think that's how it's going to happen from now on. Now I think I could get away with sort of it taking a couple of weeks to get there if it was like, I don't know, Nigeria sending money to Chad or something like that. But I just cannot get on board with it being in two Western economies of two absolutely huge banks. I just think it's kind of madness. So yeah,
Mad that it's that expensive.
yeah, it was absolutely. He couldn't believe the fee when we typed it in. He was like, "So what? Where's the fee?" I was like, "That's the fee." He was like, "That's the fee." It was like a couple of quid. He was like, "Right." He's just got absolutely ripped off. But yeah, sorry. Back onto the company's performance. I thought it was largely fine, Steve. If company's telling me it's going to do 15 to 20% and it does 14 in a constant currency, I think I can pretty much shrug my shoulders at that. I'm used to it now with Adyen and ASML. They always say they're going to do this kind of range, and it's somewhere there, or it blows out the water. So I'm fairly used to that now. But yes, on the whole, I thought Wise great. Its movement to the US, I think, is good. I think it should get full value over there, and I also think that it just becomes more and more likely to be a takeout candidate over there, Steve, because I just can't understand why anybody doesn't want this now, why anybody is waiting. All these banks are sitting on huge piles of cash. Even somebody like Citibank or somebody like that who used to be involved in this kind of thing could just leave it as a subsidiary and let it run. But yeah, just people don't seem to be interested yet, and I cannot understand why for the life of me.
Looking forward to seeing their total payment volume in their next report having gone up by around 150 quid from your dad and uncle carting money to and from Canada, which will make Wise basically bugger all money because their fees are so low. In fact, it will probably cost them less to send. Yeah, you can send an awful lot of money for 2 quid on a 0.5 take rate here, so they can send each other even more. That will be nice. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.